Hello everyone. On today's edition of The Final Bar, we're going to look at the commodities complex in a segment called ETFs Engage. We're going to look at commodities through the lens of the ETFs and understand the recent pullback relative to the longer term trends. Also try to unpack a resilient equity market continuing to push to new highs led by technology leadership, especially semiconductors. So ladies and gentlemen, this is The Final Bar. In a snowy Redmond, Washington. Thanks for joining us every weekday here on StockCharts TV to unpack today's price action from a technical perspective, but most importantly, connect it to the long-term trends. We've got a lot of interesting themes that are emerging. We have this resiliency of U.S. stocks, this continued push higher driven by the leadership names we're familiar with, right? Big cap tech essentially pushing things higher than most. But we also have a lot of other themes. We're going to look at commodities in particular today. There's been a pullback with oil, with other parts of the commodity complex, although overall holding up okay. And the question now is that a short-term pullback, a pause that refreshes before we continue higher? Or is this the beginning of a little further weakness? And so we're going to try to connect those two and think about the strength in stocks and potential warning signs, but also look at commodities as we break them down in an ETF Engage segment later today. But before we get to that, I did want to point out some of the upcoming programming that we have. We have a lot of really fantastic events coming up here. In terms of guests on this show next week, we have Katie Stockton from Fairlead Strategies, Doug Bush based in New York, two fantastic technical analysts with some really interesting charts to share with us. The week after that, we have the Canadian technician Greg Schnell joining us, and then Greg Harmon, a Clevelander like myself, sharing his thoughts on the market. And then on January 22nd, you're going to want to mark this one down. It's our 2020 market outlook. I contributed, a number of the other StockCharts commentators all contributed some segments there to sort of give you all of our different angles on what we're seeing for the markets going through the course of the year. So you're not going to want to miss that. Premieres on StockCharts TV on January 22nd. Let's get to the market recap. So as I mentioned in the introduction, we've had this resiliency in U.S. stocks, this continued strength, and it's been driven by technology. So the XLK once again at the top of the 11 S&P sectors, which really speaks to the strength in tech. There are a number of ways to think about it. We'll look at the chart. Let's look at the chart actually right now. So we have this continued uptrend. And again, go back to Technical Analysis 101, sort of traditional Edwards and McGee technical analysis. An uptrend is a series of higher highs and higher lows, and that's what we continue to see from technology. So even when the S&P is up, tech is up even more, and we see another intraday high, another closing high today. And again, when a market's in such an acceleration like this, I find it's really helpful to look at the RSI, and what you want to do is understand when it's overbought, which it has been overbought really for the last 3 to 4 weeks pretty consistently. It's sort of remained up in that region, speaks to the strength that we've seen of it. You also want to look at the relative strength to see if that starts to taper off a little bit, which would tell you maybe that other things are starting to accelerate a little further. But what you mainly want to do is start to understand when that trend is over. There's a Wall Street maxim, the trend is your friend. And one of my mentors, Tom DeMark, always said the trend is your friend unless it's about to end. So if you can look for some sort of guidepost, some sort of line in the sand that would tell you when that uptrend is exhausted or when it's nearing exhaustion, I think that's really important. So the two things I would look at is the RSI, see when it exits that overbought region. And number two, look at these most previous swing highs. So on the XLK, you have around 90, 50, 91. And as long as we remain above that on this next leg, higher, and then any subsequent pullback overall, the trend still remains pretty positive. Another way to think about that concentration in big cap tech, by the way, is to look at our Scooter report. So this is the StockCharts technical rating, looking at a percentile ranking of all the large cap universe. And if you look at this list of tickers, and again, if you're not familiar with some of these names, some I'm sure you are, like Apple, Apache, for example, in the energy space. But do you know what's in common with most of these names? At a quick glance, 7 out of the 10 are in technology. And 1, 2, 3, 4, 5 are semiconductors. So talk about a concentrated group of stocks at the top of the leaderboard. So 7 out of the 10 are in the one sector in technology. Half of those, 5 out of the 10, are in one group, semiconductors, which tends to be a good leading indicator for the markets. They tend to do well when the market's doing well. So overall, that actually speaks to that strength in technology. Let's look a little bit at the broader equity space, and we're going to get to some thematic charts. So this is what the chart of the S&P looks like. Again, we had another push higher, another closing high, all-time high for the S&P after an intraday high. We closed in a position of strength, closing toward the highs, very different than yesterday when we sold off. You know, again, in terms of warning signs, I think you always look at the RSI. Here we have this, potential bearish divergence. We had a lower peak in the RSI a couple weeks ago, the first trading day of the year. And now we're again rallying, and the question is whether or not the RSI drifts higher or whether it starts to top off a little here. And if it does, if we'd pull back in the next day, maybe going into next week, that would really confirm a bearish divergence. We haven't had it yet, but that's why I think this chart is an important one to start to pay attention to. Let's look at the Mindful Investor Live chart list. There are a couple quick charts I wanted to show with you. Boy, the comparison of growth versus value is really, really interesting. And we talked on this show in the fall about how this ratio had been in such an uptrend, telling you that growth had been outperforming value. And look at how that reversed in September. And when we had another lower high, it felt like, okay, hold on a second. This might be the beginning of a big rotation from growth into value. Talk about a trade that many people are unprepared for. But if you look what happened since then, this ratio found support around the 200-day moving average, resumed to the upside, and now you can see it's broken to new highs. So growth continuing now back in the driver's seat, recovering from that pullback, and now once again outperforming value. So that rotation to value really didn't materialize. It sort of stopped in October, and then it sort of continued to the upside. This is an equal, not an equal way, this is more pure growth versus pure value. One of the challenges here is you can double count stocks. So something like Microsoft might fit in both of those buckets. Here we have a pure growth universe and a pure value universe. Same thing. This ratio has rotated back higher in a position of strength, telling you that growth is seriously outpacing value at this point. One other chart that I wanted to show you before we continue on to other segments is looking at the sentiment read, because we had the Aaii rankings. And here's what they looked like. So here we have the push higher in the S&P. If you look at the bottom, this is looking at the Aaii bullish reading in green, the Aaii bearish reading in red. So what percent of respondents, of individual investors, are bullish on stocks, which are bearish on stocks for like the next 6 months, I think is the time frame we're looking at. And what's interesting is the last 3 weekly readings, this comes out every Thursday, the last 3 readings have gotten successively lower, less and less bulls going into this uptrend. And I was kind of surprised. Again, this is, the survey's taken earlier in the week, so it might have been some of the weakness we might have seen Monday, Tuesday that maybe spooked some people. But look at how on a week when we're again closing to all-time highs on a Thursday, that bullish reading has come down. And look at the number of bears, almost 10% more bears, double the number of bearish respondents that we saw last week. So, a bit of a more caution coming from individual investors. I don't know if that, doesn't confirm what we're seeing here. Maybe speaks to some of the discomfort some people have with the market going to new highs, because it's certainly been in a position of strength, but less survey support for that uptrend. So that is our market recap for today, really focusing on leadership themes and then some of the details behind those charts. Let's go to our next segment called ETFs Engage. We ended up getting a lot of questions in the StockCharts mailbag, or the final bar mailbag, asking about the different ETFs and how they were structured. And so what we like to do is incorporate a segment where we can break down ETFs in a little more detail. In this one in particular, wanted to talk about commodities. It's a great place to talk about commodities because in many ways, some of your best reads, especially short-term reads on commodity strength or weakness, can be done through the lenses of ETFs. One of the great benefits of all of these ETFs tracking all these different things is we get a good real-time, or short-term read on strength and weakness, because these ETFs are a lot more liquid and they're a lot more accessible to individual investors and advisors. And so they tend to be hit pretty widely. So let's look at some of the common commodity ETFs, talk about some of the patterns that we've seen. We're going to start with the GSG. This is the GSCI Commodity Index Trust. Actually, technically not an ETF, but it's sort of an equity-like. It's a unit trust, so a little different, but overall good measurement, good proxy for overall commodity strength. What is interesting about this chart of the GSG is you have a distribution phase, a downtrend that really accelerated in the fourth quarter of 2018, recovered at the beginning of 2019, but then you can see for much of the year last year, it sort of settled into this downtrend, lower highs lining up really well with this trend line using the high from the end of 2018, again in April of 2019. We retested that a number of times, finally broke through it in the fall of last year, finally resolved higher and back above the 200-day going into year end. So you have this distribution phase in commodities, then this consolidation phase where we're really range bound between about 1460 and 1620. And then we potentially have now broken out of that range. And that's what we saw the last couple weeks in December. As stocks held up very nicely, you started to see commodity strength emerge as commodities overall were doing very well. And so this really feels like a rotation away from distribution to more of accumulation, more setting up for longer term strength. The last couple days have really ruptured that. And again, there are a lot of, when you get into commodities, especially oil, gold, there are a lot of other themes that will drive this, supply and demand, geopolitical issues. So a lot of this is driven by the weighting of oil and the movement in oil related to tensions between the U.S. and Iran. Again, outside the scope of this show, what we want to do is focus on the charts. You have other places you can digest the news and try to gain some insights there. We want to look at the charts and how they relate to what you might hear elsewhere. So what we've seen now is from a technical perspective, the price of the GSG, this commodity index, has gotten back into that range. And I think this is a really key chart to pay attention to because the question is this a pause before the resumption of the uptrend? Is this just a retest of the range before we continue higher? A gun to my head, that's sort of what I would assume is going to happen here for a number of reasons. Or do we continue in this range? Do we settle back into this range and this is more of a consolidation that we just need to brace for? I think what happens with the RSI could be really helpful with helping us understand that, helping us answer that question. I would note that the last couple times that the GSG has pulled back, you can see the RSI has never really gotten below 40. That tends to be the case in a bullish configuration. When a market is in a position of strength, it'll pull back a little bit, won't really get below 40, which tells you demand is coming in, supplies exhausted, and you ride this higher. Now, one of my good friends and mentors, Walter Deemer, I made a comment on Twitter about this earlier today, and he actually responded with a fantastic suggestion, which was looking at the equal weighted commodity index. This is the GCC. This is an ETF that actually tracks an equal weighted commodity index. The challenge with things like the CRB index or the GSG that I just showed you, the GSCI Commodity Trust, is that it tracks a bunch of commodities, but they're weighted in certain ways, and usually they have an exaggerated weighting to oil prices or to energy more broadly. So if oil is struggling, that entire index will look weak because of the weighting in oil. It's kind of like the dollar index and the euro. It's such a direct correlation or indirect correlation that if one moves, it's going to cause the dollar index to look a lot stronger and weaker than it might be. So if you equal weight all of those commodities, this will put more of a weighting in the hard and soft commodities, grains and livestock and things like that. You can see that actually looks a lot more constructive. So if you take away some of the weight of oil, if you use the GCC to understand commodities, overall in a much stronger position. It tells you that commodities overall have been in a stronger point, and this little pullback that we've seen in the last couple of days actually doesn't look that bad because overall we're in an uptrend above two upward sloping moving averages. Pretty compelling. Again, I think it's a really interesting time to look at the RSI. If this pullback continues, just look and see if it remains similar to what we saw at the end of November of last year, which was a pullback to the 50-day moving average and RSI just above 40. That was the pause before we continued higher. So that's sort of what I'd be looking at with these commodity indexes. So thank Walter Deemer, fantastic longtime analyst who hopefully we will have on the show very soon with that suggestion. Now from here, what I like to do, and this is one of the chart lists that I use as my main way to look at non-equity asset classes, currencies, commodities, interest rates, and so forth. I'll point out the GLD. This is one that a lot of people want to talk about, just gold and what gold is doing relative to where it's been. And I think an interesting comment on gold, the challenge with some of the commodity ETFs is it's tough to track the underlying commodities because of rollover and how you balance them and so forth. With the GLD, it actually holds physical gold, so it's a very close proxy to the gold index. So it's not a bad way to see gold prices in particular. What strikes me looking at the GLD is you can see a very similar relationship to what we've seen here on the right half of the chart and what you see here on the left hand of the chart. I've sort of taken away before it, but you had this rally going into the beginning of last year. You had this pullback, sort of a lower highs situation, lower lows, We then resolved above that trend line, broke above resistance. We moved higher. We had an extreme overbought condition at the end of June, which told you a little bit of a pause before resumption of the uptrend. And you can see since then the RSI has remained above 40. Look at how similar we are now versus that period. We have another downtrend, a pullback, a corrective period after this nice rally in mid-year. We then broke above that, broke above the interim resistance level. Now, once again, have become extremely overbought. So if we follow that playbook from last year, that would suggest a bit of a pullback, which is arguably what we've started now, before resumption to the upside. And that's, I think, again, overall, all else being equal, I think that's what we'll start to see from gold. Now, what's interesting looking at those couple of ETFs, you think about what that might mean to emerging markets, to commodity-oriented groups or regions like Australia, like Latin American countries, for example, Brazil. So interesting to look at ETFs or commodities through the lens of ETFs and then compare it back to where you might be able to pull some levers, not just on these ETFs, but in other equity and other ETF-related bets. That's ETFs Engage, folks. We're going to take a quick commercial break. We're going to be back with my friend Tom Boley telling us how he uses Candlestick Analysis. We'll see you back in a minute. Hello, everyone. Welcome back to the show, The Final Bar. Thanks for joining us every weekday after the close to break down today's technical price action. I'd remind you, please keep your questions and your feedback coming. Tomorrow, we're going to do another mailbag segment. We'd love to answer your questions on air. So shoot us an email, thefinalbar@stockcharts.com. We look at every question you send in. Also, you can put in comments in the Q&A here during the show. This next segment is a Talking Technically segment where some of the other commentators through StockCharts.com share some of the ways they use technical analysis and use the StockCharts platform. My friend and colleague Tom Boley shared some really interesting thoughts about how he uses candlestick analysis. So let's hear from Tom Boley on candlesticks.
Candlesticks are a great visual aid in identifying key reversal areas on a chart. Let's take a look first at Johnson & Johnson, J&J. If you look back to March, and then again in April, once again in early June, and then the latter part of July, you'll see clear uptrends in play, identified with these blue directional lines. At the end of each one of these uptrends, though, check out the red circles that highlight a bearish engulfing candle. Each of these four uptrends was ended with a bearish engulfing candle. These candles represent a gap higher from the prior day close and then selling throughout the day to completely engulf that prior day's buying. In all four of these examples, after these bearish engulfing candles printed, you can see the results. Moves to the downside, uptrends exhausted. On the flip side, we have hammers that can provide great support off of downtrends. And when they occur at prior support levels, they can be even more meaningful. In technical analysis, the more types of technical signals that you can combine, typically the stronger the signal. So in this case, off of the high back in September, Johnson & Johnson sold off for about the next 3 to 4 weeks. And at the very bottom here, you can see printed a hammer which tested two key areas of price support. So in addition to knowing that this was an area where buyers would likely return, we also had a reversing hammer candlestick on this decline, which adds to that probability of a reversal. Hammer candlesticks typically look like a hammer. You'll have an open near the high of the day. You will have an intraday move down below sometimes key support, a long tail showing some intraday weakness, and then a recovery late in the day to print the close, which is down close to the open, and that's what completes that hammer candlestick. So always use these candlesticks to potentially find some key areas where we look for major reversals on charts. Can be very useful to a short-term trader.
So that was Tom Boley talking about candlestick analysis, how to think about it. I've always used candlesticks for certain things, and what I love about it, what I've always appreciated with it, is the fact that it's a very visual form of analysis. Now, I will tell you, having spent some time on Japanese trading floors, some of the Japanese banks, the currency desks, I would see them all use candlestick analysis along with cloud charts, the Ichimoku charting system, and really that visualization that you see from the solid and the clear candles, the open and closed candles, and the way that an uptrend and downtrend almost jumps off the page at you. Really interesting. So if they're not a part of your process, take a look at Chart School. That's where many people that I know getting started used our Chart School to learn candle patterns and get them under your fingers. So take a look at it when you can. Our next segment is going to be today's chart list. One of the things we love to do on the show is highlight the chart list system, which is the way that you can manage and organize your thinking, your ideas, your ways of visualizing the world around you, taking a sense of the markets. And I like to share with you some of the chart lists that I use. And the one I want to highlight for you is the one I called Market Outlook 2020. I set up this chart list, and this was what I used to actually shoot my segment of the Market Outlook 2020 special that's coming up just as a reminder on January 22nd. So make sure you mark your calendar for that. But I just wanted to show you very quickly how I set up this chart list and why I set it up a certain way and why you should have a chart list just like this in your own login. You'll notice that what I did when I set up the chart list, I put the little exclamation point at the beginning of the title, and that's so it's very much at the very top of my list. So every time I look at my chart list, I'm reminded that I had a Market Outlook 2020, and I do that so that I can remember what I was thinking at the moment that I put it together. And I sort of looked at this at the end of December. I sort of put together a series of 7 charts that I thought would be really interesting to think about going into the new year, help me sort of get a sense of asset allocation and asset rotation in the first quarter. So you should have a chart list, in my opinion, of your own set of 5 to 10 charts that you think are most interesting. Let me walk you through what I did, how I set them up, and then how I think you could use these. So for me, I wanted to touch on all the major asset classes, starting with equities. For me, I'm always thinking with equities first, so I start with a 1-year view of the S&P 500 just with the price, and with the 250-day moving averages, and then the RSI at the bottom. And I started with this because I wanted to remember the long-term trend in stocks, which has again been in such a position of strength. That fourth quarter was so strong. And question number 1 in my mind is, do we continue higher? And the way I'm going to do that, the way I'm going to answer that question is by looking at these highs and lows and seeing if and when we break below an interim low. So that 32.10, 32.15 level on the S&P I think is really important. And I'm also looking at this. Now, I don't have a lot of notations on here. I had to keep it a little clean for the show. But if I were you and this was my chart list, I would be putting a notation here. I'd put some lines on here. I would use the text system as part of the annotations, part of the chart tools, to put your own comments and date them so you know what you were thinking at a certain point. And I'll tell you why when we get a little later. Second chart was looking at breadth. So I was looking at the percent of stocks above their 200-day moving average. One of the warning signs I felt that we've talked about on the show previously is the fact that we have around 82% of S&P names above their 200-day. That's one of the highest readings we've had ever, and it lines up very, very well to previous cyclical tops, or at least tactical tops, right? Every time in the last 5 years that we've had that situation, the market has pulled back either in some small or some larger way, and I'm just very interested in that potential repetitive pattern of an extreme in breadth and what that might mean for stocks. From there, I started to go into more of a, thinking about currencies and commodities and international markets. And for me, I think, looking at the dollar is a really important theme because we had the dollar in a strong uptrend in 2019. That started to change course at the end of 2019 with the last couple of months switching to more of a bearish phase. We broke down through the last support level using the Fibonacci analysis, and the RSI has never gotten above 60 since that peak back there in September. So it's very interesting to see if that dollar weakness continues, because I think that has implications for a number of different markets. First is looking at the U.S. relative to the world. In a weaker dollar environment, that tends to mean the U.S. will underperform global markets, and this is the chart that would show that. We haven't necessarily seen that year to date. It's actually jumped back up, and the U.S. has continued to outperform. That's with all the strength in U.S. technology stocks that we've seen before, but I'm very interested to see if and when that rotates lower. I think the strength in commodities is one of the things that would drive the strength in emerging markets. And if you look at EM versus developed markets, you can see that ratio has broken higher. And then I finished off with some of the commodity charts that we actually reviewed earlier in this broadcast. So why do I have a chart list set up like this? Well, number one, it is one way to capture my thinking at a certain point in time. These charts are going to update all through the course of the year, so I would encourage you to put annotations on the chart, put trend lines, put your comments, and make sure you date them, because now every time when you come back to that chart list, you're going to see your charts with your comments. You cannot get away with what you thought at a certain point of time, and as long as you don't go editing your comments down the road and reverse engineering what you might have thought, you will have a good record of what you thought and see how the market responds to that projection or your anticipated future course. And then the final thing I'll remind you is I intentionally started the title with an exclamation point. That's one of the Arthur Hill tricks that he showed me earlier on when I was using StockCharts as a way to make sure I put these in a meaningful order. So the most important chart lists that I always want to refer to are at the very top of my list. So for me, it's my outlook for the year, so I can keep relating the market back to what I was thinking at year end of last year. And then also my main chart list, my Mindful Investor Live chart list I've shared and will continue to share with all of you. So that is today's chart list, looking at a market outlook. Again, if you don't have one set up like this, it is not too late. I would do it today. Put it at the very top of your chart list. Refer back to it, maybe as part of your weekly routine, and you'll get a sense of where the market has moved relative to your expectations. We need to wrap the show, folks, with our 3 in 3. So at the end of every show, we like to look at 3 charts in 3 minutes. If these charts are not on your radar yet, they should be from this moment on. So chart number 1 is the GSCI. We looked at this earlier in the ETFs Engage segment. We were talking about commodities and the overall strength. And again, there are a lot of ways to look at the commodity complex, but this is one that I followed for years, more than the CRB, and I like the fact of where it's broken out and then has pulled back into that range. And I think this is a really important time to watch this chart to see if we resume the uptrend or see if we continue to be range bound. And I think, again, the RSI is going to be a really good way to measure on any pullback. Do we remain in that bullish configuration with the RSI remaining above 40? So this is a really good one to keep an eye on in the coming weeks, coming months. The second chart is looking at the S&P 500, and there at the bottom, I'm looking at the new highs and new lows. So this is stocks on the NYSE, so our broad equity universe, and then the S&P 500, and what number of stocks are making a new 52-week high or a new 52-week low every day. So in general, in a bullish phase, looking at the bottom here, this is the S&P 500. Over the last couple months, look at how the number of stocks making new 52-week highs has sort of steadily increased. Today, we had 81 stocks breaking to new high. This actually might be yesterday's. I can't really see visually. It looks like today. 81 stocks. But in the last couple days, we've had sort of 50 to 70 to 80 stocks making a new 52-week high. That's a pretty big number. That's 15-17% of the S&P 500. Not too shabby there. And it shows you overall it's a broad move. A lot of stocks making new highs. Literally 0 companies in the last couple days, and only a handful in the last 4 to 6 weeks of companies making new 52-week lows. So it's certainly a broad advance, and lots of stocks agreeing with the S&P making new highs. In terms of a potential red flag, my third chart today would be the Aaii Rankings. We looked at this earlier, and the fact that the bullish sentiment has come down so much is really, really interesting. What's compelling to me is it actually lines up very well with more of a corrective period. This is what you usually see when the market sells off. You see people getting spooked, and you see the Aaii bullish reading come down. You see a lot of people get very bearish very quick. They're sort of skittish and get a little nervous, and all of a sudden they get more bearish than you might expect. We've had a huge influx of bears, almost a doubling of bearish respondents and a lessening of bullish respondents at a time when the market's making all-time highs. So while stocks are showing strength, you see this inherent mistrust of the market, which is kind of how it feels. I feel a lot of people are not trusting this move at the beginning of the year. A lot of people expecting some more weakness, maybe a little surprised. So whether or not that reverses, you see people sort of believing in this uptrend, I think could be really interesting, especially over the next month if you see what that Aaii ranking system does. Ladies and gentlemen, that is our show for today on a Thursday afternoon, snowy here in Redmond, Washington. Please keep your questions and your feedback coming. The final bar at StockCharts.com is the best way to get a hold of us at any time. For StockCharts.com in Redmond, Washington, I'm Dave Keller. Have a great night.